This is level 1 of the CFA program, the topic on portfolio management and the reading on portfolio risk and return, part 1. Of course, if there's a part 1, then there's a part 2. And it is my opinion that these two readings are really the pulse of the CFA program and the policy statement. Because what we're going to learn here in these two slide decks is the manner in which we can compute both the risk and the return objective for a client. And then we're going to learn how to efficiently allocate whatever resources are available to each client. This is a super long reading, and we have a super long slide deck. So let's go ahead and get started. What I want to call your attention to is some of these action words. Note that there's a handful of calculates there and some describes here. And what we've done for you in this slide deck is we have lots and lots of good problems. And if you look at the end of this particular reading, there are 40 some problems. And the majority of them, you actually have to calculate something. And I find this really interesting and instructive for the exam. You might notice that in several readings, when the Institute asks us to compute or calculate, their practice problems at the end of the reading, they might have one or two of those. And so we're really learning how to demonstrate. But in this reading and in part 2 as well, we need to calculate. So make sure you have your financial calculator on hand as we go through these. So what are we doing? We need to calculate and interpret major return measures. Boy, that's going to be really important. I can't imagine the Institute not asking you a handful of those questions on the exam. And then notice, skip down towards the bottom there, we're going to have to talk about mean and variance and covariance. And this is so important, not just for level 1, but also as we move through levels 2 and level 3. And then look at that bottom one. If I'm making up a test, in fact, I never make up a test in my investments class without asking students to calculate and interpret portfolio standard deviation. Then we'll talk about correlation and efficient frontiers. And then at the very end, we'll throw in a risk-free asset and see how that changes our life. So let's go ahead and get started. I did say that first LOS is important, and we have a whole bunch of slides for this one here because there are, maybe 10 of these major return measures. And so the key on the exam is to make sure you read the question fully. You'll get a bunch of stuff and they'll say, hey, let's compute holding period return or time weighted return or some type of a return. Make sure you read the question fully. All right, so holding period return, I'm guessing that you know this just from regular life. Let me go ahead and give you the quick example before we even do any of these formulas here. Suppose you have an asset today for 100 and it's 110 during the following period. What's the return? Of course, it's 10%. The easiest way to do that is just to take an F over P minus 1, future 110 divided by 100 minus 1, that gets you the 10%. But of course, the Institute is interested in complexifying these very simple return measures by adding cash flows in there. So look at the holding period return formula. So you have the ending value minus the beginning value divided by the beginning value. And then you have to add whatever income that the asset generates. Of course, the most common is a dividend payment or an interest payment. So let's go ahead and do just another quick example on top of my 110 and 100. All right, so $20 per share. Current share price has grown by 50%, 10 dividend payments, each amounting to 50 cents per share. What will the holding period return be if we do all of the selling? All right, so let's just go ahead and do this from a macro standpoint. So there's our initial investment of $10,000. It goes up by 50%, right? So we don't even need a table for that. Half of 10 is 5. So we know that we bought at 10 and sold at 15. And then we get a bunch of payments somewhere in the middle. So 2,500. So we're doing 15 minus 10 plus the 2,500 and divided by 10. That gives us 75%. Now, you could still do it by F over P minus 1. Just take the 15 plus the 2,500. So do 1,750 divided by 10 minus 1. Or you can do it the long way here with the table. Now, of course, when we look at a particular asset, and mostly in the way I teach this in my classes, this has to do with a mutual fund. So I'll say something like, hey, here's a mutual fund, and it has had these returns over the last 5 years or 10 years. What's the average? And so notice in that equation at the bottom there, we have in the numerator RI1 and RI2. Those are holding period returns. And of course, they have to be the same holding period. And then all we're going to do is divide by the total number of periods, which is a capital T. So let's go ahead and do a quick one here. 25, 10, 12, and a -3. And by the way, my students always ask me, they say, Jim, how many of these are you going to give us on a test? And I always say something like, look, if I tell you here are the last 55 years worth of returns, you need to just write a little note to me and say, dear Jim, you've lost your mind. I'm not wasting my time doing this 55 times. And so I'm guessing the Institute is going to keep this reasonable, 5 years, 4 years, 6 years. And so all we're going to do is add those and divide by 4. Now I'm going to show you a little trick on the 12C here in just a little bit with the sigma plus button. So those of you who have the 12C, go ahead and grab that sigma plus. But here's a common mistake that my students make, and I'm hoping that you guys would never do this. Of course, the Institute is going to give you some positive returns and negative returns. So don't forget to make 1 or 2 of those negative. Now, the average return gives us some measure of performance. Of course, it's the average performance over time. And the average performance measure is, of course, it's instructive. It says, okay, if we would have done something like this over the last 4 years, what was that number? 11%. So we average 11, 11, 11, and 11, right? If our returns were 11 over those 4 years, if they were fixed, then this is what we would get, 11%. But what this average return does is it ignores the effect of compounding. And that's why we do the geometric return, because it includes the impact of compounding. So your brain should be working. You should say something like, all right, Jim, I remember compounding. I remember 1 plus an interest rate back when we did really simple future value stuff. And so notice what we're doing. We're going to take the holding period return, the R sub I1 and R sub I2, all the way out. And we're going to take the decimal form of that, and we're going to add 1. And then we're just going to multiply all those. So there you have the time sign in there. And then, oh my gosh, there's the -1 there. That's like the f over p minus 1 that I did. But of course, we have to take it to the t root. So we take it to the square root if it's 2 periods. We take it to the 10th root if it's 10 periods. So let's do a quick example here. And so the geometric return from that example just a few moments ago is 10.6%. Notice that we raise it to the 1/4 because it is 4 periods. Now, what was that return back here? 11%. So the arithmetic mean, 11%. The geometric mean is less, 10.6%. That ought to make some mathematical sense because here in this case, we are including the effects of compounding so that if we start with $100, all we have to do is have 10.6% each year because we're earning interest on top of interest. I always give my students the example of owning a mutual fund when we get to money-weighted and time-weighted returns. Of course, a lot of people call this a dollar-weighted return, but think about the conversation we had in the previous slide deck on mutual funds. If I'm an open-end mutual fund manager, I say something like, here, send me your money today, send it to me tomorrow and next week and next month. And if you want any of your money back, I'll send it back to you tomorrow and next week. So there are cash flows coming in, cash flows going out. So there is a requirement for a specific return measure that will capture those inflows and those outflows that are unique to each individual mutual fund shareholder. Think of the simple example that I used just a minute ago. If you send me your money when the net asset value is 100, and a year from now, the net asset value is still 100, but during the course of the year, the net asset value of the fund drops to 50 and 40 and 30, and every time it drops, you send me a bunch more money. And then it goes back up to 100 by the end of the year. Well, if you say I started with 100 and I ended it with 100, that's a 0% return. But clearly, because you bought during the crashing and then it rebounded, you should have some substantial positive return. So that's what money-weighted return does. So look at that equation in the middle. All we're going to do is take the cash flows in the numerator at time period t, which could be 0 and 1 and 2 and 3. Some of those will be inflows, some of those will be outflows. We force the present value of those cash flows to be equal to 0. And then we solve for the interest rate. Notice that we have 1 plus the IRR. This money-weighted return is an internal rate of return. It's also a geometric return. Of course, you should have gotten that from the previous slide. And so that thing there looks like it might be a little bit daunting, but it's not. So let's go ahead and do a quick example. Now, the Institute does a good job in the reading of making sure that you're aware of these cash inflows and outflows. And so this example illustrates that complexity. So let's suppose we start with 200, the beginning of the year, and we add 250, and then we add 150. So what is that? That's a total of 600, right? But then at the end of the third year, we withdraw 400. And then we still have some left over, all right? And so what's going to happen is that our cash inflows and our cash outflows, they don't match in terms of absolute values. What we need to do is we need to throw time value of money in there to capture the money-weighted return, given, look at that last sentence there, we earn 10% in year 1, 6 in year 2, 6% in year 3. So you might think that our return is going to be, maybe it's close to 10, maybe it's 6, somewhere in there. But because of those cash inflows and outflows, we need to figure out exactly what this geometric return is. And so the easiest way is probably to put together a table. And so let's go ahead and start with 0, right? We start with 0, we add 200, and by the end of that first year, we earned 10%. So that gets us up to 220. Then we add 250, and we earned, what did we earn that second year? 6.6%, so that gets us to 31. If you're following along with your calculator, I think we left off a couple of pennies in there. And so you add the 470 plus the 31, you get 501. Add 150 to that, multiply that by 6% in that third year, so there's the 39. Once again, I think we just ignore some of the pennies in there. Then we take out 400, but we still have 290 in there. So let's go ahead and figure out what that dollar-weighted or that money-weighted return is. So before we do the math, I want you to go ahead and look at the cash flows that we have over there on the top right. There's that equation from the previous slide. But now cash flow 0 is going to be a minus 200. Cash flow 1 is a minus 250. Cash flow 2 is going to be a minus 150. So those are cash outflows during those first handful of years. Then we start redeeming our shares. So we get 400 and then we're left with 290. Now, even though the question stem on the previous slide doesn't tell us that we sell at the end of year 4, well, that's the value at the end of the year 4. So whether or not we sell, that's still going to come up with that internal rate of return. So there's our long-term equation. We're going to solve for the IRR in the numerator based on those cash flows. Let me just comment and say we're forcing that to be equal to 0. Now, every textbook out there says, hey, now's a good time for you to learn how to guess and guess again and guess again. So you guess for an IRR and you compute it. And if the NPV turns out to be 0, then you know you're right, but you're not going to do any of that stuff. So get out your calculator and hit your cash flow button. Enter those 5 cash flows in year 0 through 4, and then just hit your IRR button. You get 572. Which, let me go back here. Notice that 10 and 6 and 6 and 6. Notice that that 572 isn't equal to any of those. In fact, it's less because it's a geometric return. Now, how about a time-weighted return? This is a measure of performance of a particular asset regardless of those cash inflows and cash outflows. So in my previous example, if we started with 100 and we ended with 100, then the time-weighted return would be 0. And so all we're going to do is exactly what we did before for the geometric return. And look at the third teardrop point in there. We have bolded the words geometric mean in there. So all we're going to do is we're going to go ahead and add 1 to each of those individual returns. Now look at the 1, 2, 3, fourth teardrop point. The reading says something like, hey, you could do this for daily returns. So if we have daily returns, 1 plus R1 is day 1 and R2 is day 2. Now, of course, the daily return is going to be like, 0.000 something, right? So they're going to be teeny weeny. And you're going to compound those out. You're going to multiply those 365 times. Now, of course, if the CFA Institute gives you a column with 365 daily returns, you can do what my students do. Just write a little note. Dear CFA Institute, don't do this to us because it's going to take way too long. And then you just subtract out 1. Now, go ahead and, that's a really good way to get you a good sense of what a time-weighted return is. But skip down to that last teardrop point. This is probably how it will be given to you, where you're given annualized returns. There's the R1 and the R2. And then you just do this exactly like we did the geometric return. Quick example here. $44, $3 dividend, 46. 57, no dividend during that last time period, time-weighted return. So all we're going to do is compute those holding period returns. For the first year, that turns out to be 1136. For the second year, that turns out to be 2391. So that's just another illustration of what we did. What was that back on that very first slide in this slide deck? So we add 1 to each of those decimal forms of the holding period return. And since it's 2 years, we raise it to the 1/2. And there we get 17.4%. Here's a good question. How do you go from, here, watch this. Whoops. How do you go from daily or weekly or monthly returns to annual returns? And how do you go backwards here? So to annualize a return, all we're going to do is compound them out by the number of periods during the year. And so look at what happens down there at the very bottom in our example. If, in fact, that we have earned 5.4% in the last 52 days, well, what does that mean? In order to annualize that return, if we earned 5.4% in 52 days, then we assume that we earned 5.4% in the next 52 days, and the next 52 days, and the next, and the next, and the next, until we get up to 365. So that's why we're going to raise it to the 365 divided by the 52. And then, of course, we subtract 1. So there's the annualized return, 5.4%. We raise that, we add 1 to it, and we raise that to whatever that fraction is, and we subtract 1. And of course, we get some huge number around 45%, because if we manage to make 5.4% in 52 days, boy, that's going to really compound out. Notice that we're adding 1 to it, so this reflects the compounding. Boy, this is a really good question here. I'm guessing, I ask my students this all the time, and I think you guys are about the same age. I say, have you guys ever experienced during your lifetime any periods of inflation? And they all say, pretty much no, because they're 20 years old, so we haven't had inflation since I was in high school, or at least massive inflation since I was in high school. But that changed in 2021 and 2022, where now we have substantial inflation. Now, of course, the CFA Institute always claims that they don't ever use current events here, but I would suspect that some question in the next year or two would reflect higher nominal rates of interest, because inflation has been spiking. So what we need to do is we need to separate the nominal, or the stated rate of interest, from its two components, the inflation rate of interest and the real rate of return. And so what we're doing here is we're going to go ahead and compute the real rate of return, and we're going to reflect compounding here. So we're going to add 1 to the nominal rate and 1 to the inflation rate, take that fraction, This is what you should be saying. You should be saying, wait a minute, Jim, isn't this just like an f over p minus 1? Of course it is. The future value, the f, is the total, the nominal, the stated rate of interest. And then you divide it by the present value, or the inflation rate. So f over p minus 1. So if you do 55 and 25, you get a real rate of return of 2.93%. How about gross, net, and pre-tax and after-tax returns? These are just super simple calculations. Of course, gross and net returns, those are appropriate for some managed portfolio like a mutual fund or a hedge fund. And then pre and after-tax returns, of course, these are relevant for all of us. And so the easiest way to do this is to net your total return or your gross return by either the management fees, custodian fees, or the tax rate. So look right above the green box. So we have the 120 times 1 minus the management fee of 5%. So just think of it, you're really only getting 95% of the gross return. And then down there at the bottom, if we have a 15% return and a 25% tax rate, we're only getting 75% of our total return. Yeah, this is probably one question on the exam. I always ask my students about cash accounts and margin accounts. So look at that first arrow point there. If we have an asset that we start at 5 and it ends up being 7, so that's a 40% return. That's just an f over p minus 1, right? 7 divided by 5 minus 1 is 40%. And that's the cash account. That's if the investor puts up the entire amount of the investment with cash. But let's suppose that of that 5,000 that the investor borrows half of it. So 2,500 is cash and 2,500 is a loan. And so the leveraged return, now this is before we deduct interest expense. And so all we're going to do is the same f over p minus 1, but we need to make a little bit of an adjustment. And so we went from 5 to 7, so that's 2,000, but we're going to divide by just 2,500 because that was the amount of cash, the amount of equity that this investor put up originally, and so the return is doubled. That should make sense, right? If you only use half of your money, then the leverage return should be twice. Now, of course, make sure you're aware that at some point the institute could say, hey, you borrowed 2,500 and you paid a 10% interest rate. So 10% of 2,500 is 250. So in the numerator, you would do 7,000 minus 5,000 minus the 250, and then you would divide by that same 2,500. Here's this slide I promised you just a few moments ago that relates to the specific LOS, compare money weighted and time weighted. I think we mentioned all these, but this is probably a good one to memorize. Get your phone out and take a quick picture of this one here. Now we get into the second part of the chapter title, right? It's called Risk and Return Part 1. So let's go ahead and start our conversation on top of, what do we do? 8 or 9 or 10 different return measures. Let's go ahead and add the risk element to it. And of course, you guys know this from previous recordings and probably just previous conversations that you've had during your life, that the easiest and most common way to measure risk is through the standard deviation of returns. So look down the left-hand column. So here are several different asset classes. Here's their average annual nominal return. All right, so that's important. It's an average, it's annual, and it's nominal. And this goes for, almost a 100-year period, 1926 to 2008. And by the way, you see a lot of tables are put together starting in 1926. That's when they started keeping more specific details, right during the Roaring 20s, when everybody was super happy and you could buy $100 worth of stock for just $5 on the floor of the New York Stock Exchange. Boy, that didn't sound like a recipe for a stock market crash in 1929, does it? All right, so notice then that over on the right-hand column, we have standard deviations of each of these. And so this is really, if this is the first time you've seen a table like this is a great introduction to the concept of allocations and risk and different risk characteristics depending on the asset class. I mean, look at the difference between a standard deviation of treasury bills, short-term government securities, just about 3% versus 33% for U.S. small stocks. All right, so what have we done here? Let me give you a quantitative methods kind of a discussion. Think about this. Let's suppose that we take one of our favorite stocks. I mention this one all the time, Hershey Foods. Everybody loves Milton Hershey. Everybody that doesn't have chocolate allergies or peanut allergies loves Milton Hershey. So let's suppose that we go out and we collect lots and lots of data on historical stock prices for Milton Hershey, and we put them in an Excel spreadsheet and we convert those to monthly or weekly or annual returns. And we want to try to figure out the distribution. So the first moment of the distribution is the mean. We've already done that. The second moment of the distribution is the standard deviation. We did a little bit on the previous slide, but we did lots more in previous recordings. But the first and second moment of the distribution, those are not the only moments of the distribution. Now, if you look on the left-hand bottom side where we have a bell-shaped curve, a symmetric distribution, then all we need are the mean and the standard deviation to fully describe the distribution. That's a condition under which the mean and the median and the mode, those are the same number. That's a symmetric distribution. But sometimes we have third moments of the distribution, and that third moment is skewness. So of course, it's not symmetrical, and there are two choices. You can have positive skewness, so look in the middle of the bottom, that's where the mean is greater than the other two. Or we can have negative skewness. That's where the mean is less than the other two. And so just remember positive skewness and negative skewness. This is when the distribution, it doesn't look like a normal distribution. It's skewed this way or skewed that way. Now, of course, if there's a third moment of the distribution, maybe there's a fourth moment of the distribution, and this is called kurtosis. And kurtosis really is just an adjustment to either the height of the normal distribution or the tails of the normal distribution. So I want you to think of a distribution that is kurtotic. It simply means that it looks an awful lot like a normal distribution, but it's either tall and thin or short and they have thick tails on either end. And this is what you should be thinking. You should be thinking, wait a minute, Jim, let's go back to the 2008 financial crisis. Let's go back to the COVID crisis. Let's go back to the inflation crisis where we have something really, really bad happening and all of these equity securities are falling in values. Their correlation coefficients are converging to 1, so diversification isn't working very well. So we need a measure of that thing down on the fat left tail, and we call that kurtosis. And so my students always love it when I tell them about leptokurtotic and platykurtotic, or just kurtic and kurtic either way. And so look at the third bullet point there. A normal distribution has a kurtosis of 3. That's probably something that I would memorize. But sometimes there are high kurtoses and low kurtoses. So remember positivity and negativity. So positive has peaked and negative has a flat distribution. And remember that the key in this kurtosis fourth moment of the distribution is what goes on in the tails, because we want to avoid all of those losses on the left-hand side of the tail. Now look at the bottom diamond point. This is probably a sentence that I would remember. distribution of returns exhibiting high kurtosis tends to overestimate the probability of achieving that return somewhere in the middle. Call it the point of central tendency or the mean return, because you overestimate that probability because you're underestimating the probability of a huge loss over on that left-hand tail. How about some market characteristics? What do we know about the floor of the New York Stock Exchange? If you show up with 100 shares of Milton Hershey stock, what are you probably going to be able to do? You're probably going to be able to sell it, right? If you show up and you want to buy 100 shares of Milton Hershey, you'll probably find somebody. So floor of the New York Stock Exchange, we think of massive volume, which means massive amounts of liquidity, which probably means that the spread between the bid price and the price and the ask price is probably pretty narrow. And because there are so many buyers and sellers, the price impact is probably minimal. But then as we move out into markets other than the floor of the New York Stock Exchange, to maybe smaller cap stocks, maybe to stock markets that are in developing countries or emerging market countries, these are there are super problems with liquidity in these other markets. So when we assign our client to an asset class in, let's say, an emerging market, we need to consider those liquidity risks and those liquidity costs. So look at the last diamond point. Oh, other characteristics: analyst coverage, firm size, and availability of information. We talk at length about that, those different characteristics, especially when we talk about efficient markets hypothesis. I always have my students do this, and this is a good quick assignment for you guys. Go to Yahoo Finance, type in a ticker symbol, like Milton Hershey, and then down on the bottom right, there's a link to analyst coverage, and you can see how many of the major analysts are following Milton Hershey, and there's probably 8 or 10 of them. But if you typed in Jim's Hammer Company, assuming I have a hammer company, you'd probably find 0, because nobody's interested in little old Jim's Hammer Company. Now, what we need to do is we need to go ahead and piggyback on what we did before so that we can move into a portfolio analysis. So what have we done before? We went ahead and we computed the average. And so here's just a simple reminder of what that average is. But then let's go ahead and talk about standard deviations and variances and covariances and correlation coefficients. And so those things, they all are based on the first moment of the distribution, the average or the mean return. And there's that equation in the middle. We did that before. And so all we're going to do is we're going to say something like, all right, let's put these individual assets, Milton Hershey, Johnson & Johnson, and York Water Company, and one of the alphabets or a handful of the alphabets. So let's go ahead and compute that portfolio return. So this is super easy here. So we have 2 assets, A and B. Returns are 15 and 10%. Now, you might want to say something and be tempted to say, let me just add those 2 and divide by 2 and get 12.5%. But the weight of the asset A is 25%, which means the weight in asset B is 75%. So we can't take just a simple average, right? 15 plus 10 divided by 2. We need to weight those. So notice down there at the bottom, we're going to take 25% times the 15% in A plus 75% times the 10% in B. And we get 1125, which is less than the 12.5 of the simple weighted because we had more invested in the lower performing asset. On an exam, I have my students do this. How many stocks do I give them? Maybe 4. I mean, the institute, they're not going to give you 186 of these. But you might have to put together a table, or at least, craft a table in your mind to do this. So be prepared to do 4 or 5 of these, I would think. Now, the question then becomes, if we have a portfolio mean, let me go back here quickly. If we expect to get 11 1/4, the next question is how much risk do we need to take? And that's where this idea of variance and standard deviation comes in. So remember, mathematically, what we do is we first calculate the variance, and then we take the square root of the variance to get the standard deviation. And I tell students this all the time, that variance and standard deviation is really just a measure of how wrong you are. Let me go back here. So we have this portfolio, and so we're expecting to get 1125 out of this 2-asset portfolio. Well, let's suppose that we construct these weights, and next year we get exactly 1125, and we think, hey, we were perfect predictors. But of course, in real life, we're never perfect predictors. If we get 50% next year, we're thinking, hey, that was awesome, right? We had a great return on our portfolio, but we have to admit that we were lousy predictors. And if we lost 50%, that's not good. We're super unhappy, but we also have to admit that we're lousy predictors. And so variance and standard deviation is a measure of how accurate is that prediction. If you have a high variance, then you stink at prediction. If you have a low variance, then you're pretty good at prediction. And the idea is that if you have a high variance or a high standard deviation, then you have lots and lots of risk. Now, moving from the mean of a portfolio to the variance of the portfolio is a little bit tricky. What you would think that we would do, let me go back here. Suppose that we had a variance and a standard deviation for asset A and asset B. What you might be tempted to do, let me go back here. You might be tempted to use that equation at the bottom. You might be tempted to say, oh, let's take 25% of the variance of A and 25% of the variance in B and do that computation and get the answer and move on with your life. But what you would be doing is you would be ignoring how A and B move together. Suppose A and B move exactly with each other. Now suppose that they move exactly opposite of each other. And now suppose that they move independent of each other. Those are the 3 choices. So what we need to do is we need to capture that, boy, I call it co-riskiness in class. That's really not a word, but let's call it co-variability. So to get the portfolio variance, what we're going to do is we're going to sum the weighted variances as the first component. That's that sigma from I equals 1 to n. And then we're going to add all of those co-riskiness figures or the co-variability figures. So that's why we have covariance between R sub I and R sub j. So look at that bottom equation there. For a 2-asset portfolio, the variance of the portfolio is the weight 1 squared times the standard deviation 1 squared plus weight 2 squared times standard deviation 2 squared plus twice the weight 1 times weight 2 times the covariance between asset 1 and asset 2. Now, don't get too bogged down in the fact that those are squared. Remember that in order to derive these formulas, you probably need some calculus in there, and you probably need to take some derivatives, and so you just end up with a whole bunch of stuff there. So don't worry about where those things came from. Let's just worry about memorizing that formula. All right, let's start with the mean and variance and standard deviation of just one stock. All right, so let's go ahead down the left-hand column. We have years 1, 2, 3, 4, and 5. We have returns. Notice they're all positive: 10.5, 8.5, 6, 12.5, and 13. All right. So what we want to do is we want to see how wrong we are every time. So all we're going to do is we're going to take the difference between each one of those individual annual returns minus its most likely return or its mean return. Now look at the gray box down at the bottom. We can easily compute that mean return of 10.1%. Add that second column, divide by 5, you get 10.1. So go into the third column. In that first year, we were expecting 10.1 and we got 10.5. So we were pretty close, right? 0.4. Then in the second year, We were expecting 10.1, but we got 8.5. We were a little close, but we were not as close as we were in that first year. And then the third year, boy, we got 6, and we were expecting 10.1. So we were not close at all, right? Minus 4.1. And you do that same for each 5 years. All right, so notice that third column is a deviation from the mean. We call that thing the deviation from the mean. In the reading, I call it, how wrong are you? And all we're going to do is sum those things, but we have to be super careful. We can't just sum each of those because some are positive and some are negative. And so the positivity and the negativity are going to cancel each other out. And it might be that we could have lots of errors here, but if these errors and these errors exactly cancel each other out, then we'd be left with a sum of deviations from the mean that equals 0. So that's why we square the deviation over on the right-hand column. And then we sum them, and we get 33.7. Sum the squared deviation. So all we're doing there is getting rid of the negative so that the positivity and the negativity do not cancel each other out. And then we're going to divide by 5, and that gets us a variance of 674. And take the square root of that, that gets us 2.6. Notice our last bullet point, standard deviation, is the square root of the variance. Now remember earlier I said I wanted to show you a trick with the 12C, so I'm going to go ahead and do that. And my 12C, it fell on the floor during a previous conversation. So you guys know I do this all the time. I love my 12C. You can see how old it is here. In fact, I used to have a sticker right here. It was the AIMR sticker, which they used to put on your calculator back in the old days. All right, so this is what I want you to do. I want you to find, and I got to take my glasses off here. I want you to find the sigma plus button down here on the bottom right. So do a gold sigma, make sure you wipe out everything. And all we're going to do is enter those returns. So are you with me? So let's do 10.5 sigma plus. Notice it says 1. And then 8.5 sigma plus. And then 6 sigma plus. And then 12.5 sigma plus. And then what's that last one? You can see I can't see very well without my glasses. 13. So your register should say 5. Now, here's the cool trick here. I want you to hit the blue, your G button, and look under the 0, there's an X bar. So do gold X bar, and there's your 10.1. So this is probably how you're going to answer this question on the exam if the institute says calculate the mean and then the standard deviation. Now, there's a little trick here that I want to show you. The institute and in the reading, they're not too careful about differentiating between the sample standard deviation and the population standard deviation. Here we're doing the population standard deviation, and that's what they tend to do inside of the reading. So in order to get the population standard deviation, what we're going to do is we have the 10.1 in here. Hit the sigma plus button again. So now you have 6 numbers. You added another number. So now do the blue and look under the decimal. There's an S. So do gold, do blue decimal, and you get 2.59. And there's the population standard deviation. Now, if they asked you for the sample standard deviation, all you have to do is hit the blue dot, the period, before you add that mean back to the standard. You add that mean and get up to 6. So be very careful on the exam whether you're asked for population or sample. Now let's go ahead and what do we do here? Whoops, I went back too many. Here we did the mean and standard deviation of one asset, but what we know is we're going to own well-diversified portfolios. So we need to figure out what that co-riskiness is, what that covariance means. And this is really, really simple. Remember back here on this table, notice what we did. We took 10, I'll just do the first year. We did 10.5 minus 10.1 equals 0.4. Well, imagine that that was for asset A, and imagine there was another column for asset B. And we did the same thing for asset B. We took the year one return minus the mean return for asset B, and we got a difference. And that's all we're going to do here. So look at this equation. So notice we have covariance is equal to R sub I minus the mean of I times R sub j minus the mean of j. And so instead of, let me do this for you, instead of that far right column where we're squaring the difference between the two, we're just multiplying the difference between two assets' degrees of error. Now, one of the fascinating things about covariance is that it can be almost any number. It could be a minus 642, it could be 0.23, or it could be a positive 6 billion. And so notice what we have on that third diamond point there. It can range from a minus infinity to a positive infinity. But I said this to you in previous recordings. What statisticians love to do is they love to take a random variable that can take on almost any value and put that data set into a vise and squeeze the vise down so that it's manageable. So if you take the covariance between asset I and asset J and you divide it by the product of the two standard deviations, not the two variances, but the product of the two standard deviations, you get something called the correlation coefficient. And I'm guessing that you know this, that correlation coefficients, here, see how powerful I am. I got the vise. I'm squeezing it all the way, -1 to +1. I mean, if I came to you and said, hey, the covariance between the number of three-point attempts that Steph Curry takes during an NBA Finals and the number of milkshakes that he drinks in the day before the game is 285. You would look at me and you say, man, I have no idea what that means. But if I said to you the correlation coefficient between shots taken and milkshakes drank, whatever the past tense of that word is, if that's 0.9, well, then you know that there's a substantial positive relationship between those two variables. So the correlation coefficient is a standardized covariance. They can be positive, they can be negative. When they approach 1, +1 or -1, they have a strong relationship. All right, so let's try to figure this out mathematically. Notice that there's the calculate part of the LOS. I just gave you the interpret part of that LOS. So let's do probabilities like the reading does. We have probability of an economic expansion 70%. Probability of an economic recession is 30%. All right, so we have security I and J expected to return 20 and 15% during an expansion and 2 and 1% in a recession. So let's go ahead and compute the covariance. What we need, first of all, is the expected returns for each. So we're going to take 70% times 20% plus 30% times 2%. That gets us 14.6. We do the same thing for security J and we get 10.8. All right, so this is how we compute the covariance now. All we're going to do is the same thing. We're going to subtract the 0.2 minus the mean, 14.6, and we're going to multiply it by the 15 minus the 108. And you see how we're taking the difference. How wrong are we going to be? Just like we did with variance, but now it's not inside of one particular assets. It's how wrong we can be in the relationship between two assets. And if you do all that math, you get a covariance of 0.00529. Now, what we can do is we can go ahead and calculate the variance and standard deviation of each of those two. And we've done this before, so all we're doing here is adding probabilities to this one. And so you get 0.82 and 0.64. And if you take the covariance over here and you divide by the product of the two standard deviations, you get a correlation coefficient of 1, which, of course, you guys probably know this. There are hardly any assets out there that are perfectly positively or perfectly negatively correlated. But here, this gives you a sense of what's going on. All right, let's go ahead and talk about where individual investors fit in this risk reward, this risk return plane. Yeah, so I want you to just imagine for a second that you're standing in the middle of the floor of the New York Stock Exchange with a big wheelbarrow full of money, and you're not sure what to do with it. And so you have some choices. You can buy high-risk stocks, you can buy medium-risk stocks, and you can buy low-risk stocks. Well, you're going to gravitate to those traders out there who are selling either high or moderate or low-risk stocks, depending on your level of risk aversion. All right, and so risk aversion means not that individuals hate risk. It means that they're averse to risk, which means something like they're aware of risk. They know they're taking risk. Sometimes it's really super important, but sometimes it's not. So we divide these individual investors into different types. So a risk seeker. This risk seeker maximizes both risk and return. And so a risk seeker will say something like, look, this is where I am today. I have, let me just pick two numbers. I have 10 risk and 10 return. And if you want me to take 11 return, if you want me to search for an 11 return, I don't really care how much extra risk I have to take, right? They're willing to accept greater risk for the potential of higher returns. Now, what this implies is that these risk seekers might be more amenable to investing in derivative securities like an option contract or a futures contract, and maybe even emerging market equities. Now, we need to put a comma next to some of these sentences here. The reading doesn't get into much more than what we have on the slide, but there's probably a comma in that, boy, a risk seeker is not just out there going to, let's say, Milton Hershey Park and going on the loop-de-loop or whatever those crazy rides that I don't ever get on, because why would I want to get sick in the middle of a beautiful sunny day? But I don't want you to get the sense that risk seekers are thrill seekers, that they totally ignore risk. But sometimes they may make decisions that might lead you to think about that. We'll talk about that in future slide decks. Risk neutral is an investor who will pursue a portfolio offering higher returns, even if it comes with higher risk. Oh boy, this sounds super interesting. We're going to have discussions on derivative securities where we assume risk neutrality. And this risk neutral assumption is super appropriate for pricing derivatives, but probably not so for pricing shares of stock or bonds. But just remember what we have written there in the bolded, even if it comes with higher risk. Now, most of us, of course, are risk averse, in which there is a systematic relationship between the extra risk that we're willing to take in order to achieve some kind of extra compensation. So notice what we have in that bottom sentence there. This investor will prefer a portfolio with a lower certain return than a higher return that is less certain. Risk aversion, risk neutrality, and risk seeking. Now, risk tolerance. This is a concept that captures, let me go back here real quick. It captures these investment types inside of the policy statement. Remember that we're going to put together a return objective, which is probably going to be some math based on one of those 9 return measures that we talked about in the beginning of this slide deck. But then we need to switch over to risk. How much risk is an individual or an institutional investor willing to take? And this is called risk tolerance. And so notice that's super important there. An investor is willing to take. Now, what we're going to do as we get through to this policy statement is we're going to have to separate a client's ability to take risk and the client's willingness to take risk. These are two different kinds of things. All right, so let's go ahead and remind ourselves about risk tolerance, which is going to be captured over on that right-hand side in the covariance. And inside of the variance, those terms, they're going to have some relationship to whether we're a risk seeker or risk neutrality or a risk avoider or a risk averter. So what we're going to do is we're going to try to pick portfolios for our client in which the return objective matches their risk tolerance, and this is where it's going to come from mathematically. So look at the top formula. There's the variance of the portfolio. That's with the covariance term on the right-hand side. Then if you skip down to the bottom, there is the equation with the correlation coefficient inside of that formula. So very important that you know this. Notice the LOS says calculate. And so make certain that if you're given covariance, you use the top one. If you're given correlation coefficient, you use the bottom one. Now, of course, what we need to do is that we need to take the square root to get the standard deviation. So right here, this is variance, right? So take the square root. So in the blue box, there's portfolio variance. That's just a repeat of what we had on the previous slide. And then standard deviation. Take the square root. Man, don't do all this work on the exam and then forget to take the square root, because the Institute will have as choice A will be the variance, and you'll get it and you'll say, oh, there's the answer. And if you take the square root, you'll get the correct answer. All right, so let's do a quick example here. We've got asset 1 and 2, 80% in asset 1, 20% in asset 2. Expected returns are around 10 and 16%. Standard deviations are 17 and 30%. So this is really interesting. So notice, let's suppose that we're starting with asset 1 that has a mean of 10 and a standard deviation of 17. Then what we'll do is we're going to take 20% of our wealth and add it into a asset that has greater return, right? 15.8 is greater than 10 and greater standard deviation. So it has higher expected return and higher risk, and it has a covariance of 0.005. And of course, at this point, I have to make a reference to James Bond. There was never a 005 in any of the movies. How sad is that? All right, so let's do the easy calculation first, right? We're going to take for portfolio return. We did this before. We're just going to take 80% of the about 10 and 20% of the about 16. So we get 11.14. That should be a super easy calculation. So let's go ahead then and do the portfolio variance. We're going to take 80% squared times the standard deviation squared. Don't forget to square it. Now, if you're given the variance in the question stem, you don't have to square it. Make sure you're sensitive of what's given in the stem. We're going to add 20% weight squared times the 30% standard deviation squared. And then we're going to add 2 times weight 1, which is 80%, times weight 2, which is 20%. And by the way, the 2 there is not because there are 2 assets in the portfolio. It's because asset 1 co-varies with asset 2, and asset 2 co-varies with asset 1. So you have to count it 2 times. And then we'll multiply by the covariance, which is the non-James Bond 005. And you get 2369, take the square root, and you get 15.39%. Now, it's at this point that you should jump up and down and high-five yourself, because this satisfies, I'm going to say, 10 LOSs out there inside of level 1, level 2, and level 3. And the LOS says something like, explain the benefits of diversification. Well, look at what we just did. We started with asset 1 that had a standard deviation of 17%. We added a riskier asset 2. It had a standard deviation of 30%. But what happened when we combined those two into a coagulated portfolio? That's not a finance word, by the way. What has happened? We've lowered the standard deviation. So we've taken a risky asset, we've added another risky asset, an even riskier asset, and we've lowered total risk. This is worth at least one high five. Now we have a couple of slides here about how does correlation impact portfolio risk, and you'll love some of these examples here. So the question then becomes, we know that correlation goes from a -1 to +1. +1 means positive correlation, so there are some diversification benefits, but not perfectly diversification benefits, all the way down to a -1 where we just have the opposite, and then 0 where the two assets are not correlated. So let's go ahead and do a little bit of math here. Let's go back to an example, asset 1 and asset 2. Notice we just picked an equal weighted portfolio here. So 50% and 50%. Expected returns are 20% and 20%. And the standard deviation is 30% and 30%. All right, so asset 1 and asset 2, they look an awful lot alike. All right, they look an awful lot alike. From there, you ready for this? First moment of the distribution and second moment of the distribution. But let's suppose in this first example that the correlation coefficient is 1. So if we do the calculations for return and standard deviation, what do we get? We get 20% and 30%. That should make perfect sense. So adding asset 2 to asset 1 does us no good from a risk and return perspective. So look at the comment down there. Portfolio risk is unaffected, simply the weighted average. All right, let's go ahead and throw in a 0 correlation coefficient. And notice that we have bolded the red 0 in that bottom right part of the equation for the portfolio standard deviation. So when you multiply by 0, it wipes out that third component of the equation. Wow. So if the correlation coefficient is 0, then notice we started with an asset that had 30% standard deviation. We have added an asset that has 30% standard deviation. And our risk has fallen to 21%. There is a diversification benefit with a 0 correlation. Now, let me go back here. Here's +1, 30%. Here's 0, 21%. So if we had a bunch of other slides that had correlations of 0.9, 0.8, 0.7, all the way down to 0, we would go from 30% to 28% to 26%, right, to 25 down to 21. The diversification benefits increase as correlation goes from +1, where there was no diversification benefit, to 0, where there are substantial diversification benefits. 2, are you ready for this one? 2, correlation coefficient of -1. Oh my gosh, what does that mean? That means that when one asset does something, the other asset mimics it completely and perfectly in the opposite direction. So notice our portfolio return is still 20%. But then in the bottom right, instead of putting 0, which wipes out that whole third component of the equation, we put in a -1, which does nothing to it mathematically, but it puts a minus sign in front of it instead of a plus sign. And what that stuff does on the third component, it wipes out the first two components. And so our standard deviation is 0%. So what do we learn? If you find two assets that are perfectly negatively correlated, you can get some kind of a return, 20% in this case, with 0 risk. Wow. And so if we had, let's do this, if we had a bunch of slides in between where the correlation coefficient was a -0.1 and a -0.3 and a -0.5 and -0.6, et cetera, we would go from a standard deviation of 21% to 18% to 14% to 6%, all the way down to 0%. These are super cool slides to illustrate the benefits of diversification. But what are we doing here in this LOS? Describe the effect of a portfolio's risk that are less than perfectly correlated. Boy, this is a beautiful slide deck that illustrates this topic perfectly and completely. All right, so where are we in our life? Now, we started with one asset. We added a second asset, but what do we know? We're going to add a third and a fifth and a 10th and a 40th and an 80th and however many it means to put together a diversified portfolio. So what do we want to do? What we want to do is we want to arrange all of our assets into a portfolio that is efficient. What does efficient mean? Efficient means that we want to find the locus of points in which our standard deviation, in which our risk is minimized at every level of return. And that's called an efficient frontier. And notice our second diamond point. This represents all the dominant portfolios, which means that we don't like any of those other portfolios. And here is a great example of the efficient frontier. There's the green locus of points. Notice that that's a curve. But let's go ahead and back off and look at what labels we have. On the horizontal axis, there's risk, right? We have standard deviation of the portfolio. On the vertical axis, we have expected return. So this is a space, risk and return space. Notice all the blue dots. They represent the individual securities in a portfolio. So what we want to do is we want to arrange those individual securities on a portfolio so that we get the most out of them. We're taking those individual stocks and we're going to weight them so that we move to the left and upwards, right? What's the goal of any investor? The goal of any investor is we want to take as least risk possible. This is a risk-averse investor, by the way. The least risk possible and get the most return. Now, these are kind of mutually exclusive objectives, right? You can't have zero risk and lots of return. Now, let me put a comma there instead of a period. We've had conversations about arbitrage before, so assuming that this is an efficient market and there are no arbitrage opportunities out there, then what we want to do is we want to take the least risk possible and get the most return. Now, this is the analogy that I give my students. And this is not a perfect one, as many of my analogies are not. But this is what we're trying to do. I want you to imagine that all of you who are watching this, you are big, strong men who wear helmets and football shoulder pads. And you're the offensive lineman. And what is your goal? Your goal is to push the defensive lineman as far back as possible, right? There's that old cheer. I don't think they do it anymore. Push him back, way back. So this is what the offensive linemen are doing. They're starting over here, and they're pushing as hard as they can. They're trying to minimize risk. And then they're pushing up as hard as they can. They're trying to maximize return. Now, of course, they can't ever get to the vertical axis. Of course, when the offensive linemen push the defensive lineman back into the end zone, they get a touchdown, right? That's the limit. And so there is a limit, and that's that green bullet point. And that's called the global minimum variance portfolio. With those handful of blue individual securities, you can't get less risk than that global minimum variance portfolio. And so you can easily do this in an Excel spreadsheet using the solver function, which I have my students do every semester. And this is, it ignores return at all. Calculating that global minimum variance portfolio is super easy. But then all you do in solver is you just add some return constraints to it, and you can draw that green efficient frontier. And that's all it is. It's a locus of points in which standard deviation is minimized at every level of return. Why so much emphasis on the efficient frontier? The portfolios lying on that minimum locus, that locus of efficient points offers the maximum expected return for their level of variance. Oh my gosh. So efficient portfolios use risk efficiently. So think about those football players pushing to the left and pushing up. We let them do all the work. Now, it's not really football players. We just let Excel or some other efficient portfolio software do it. Boy, notice that last sentence and the second diamond point. This simplifies the selection process. And what happens then is that we get to an optimal mean variance choice. So I want to go back to this graph here. This is so cool. I spent so much time talking about this during the semester. And then I have my students go to the Morningstar software and download stuff from mutual funds, and we play around with efficient frontiers. You can do all this stuff with Morningstar. It's really, really cool. But what we're trying to do here is we are trying to find the appropriate portfolio for each of our clients. Every one of our clients is going to lie somewhere on that efficient frontier because they want to get the most, right? The most return for each given level of risk, which is probably dependent on things like standard deviation and risk tolerance. Now, remember what I said at the beginning of this slide deck a long, long time ago, that what we're going to do is we're going to calculate and estimate and draw that efficient frontier. There's the green line. And then we're going to throw a risk-free asset into it. So suppose, let me go back here. Suppose that we have all these assets here. And there's Milton Hershey stock and Walmart stock and Johnson & Johnson. All those different kinds of large cap stocks that we like. We put them in a portfolio, right? And let's suppose that we get that minimum variance portfolio over on the left-hand side. Suppose then that we add a treasury security to it, some risk-free asset. Well, the whole life changes. Notice here, that green is a curve. So the relationship between risk and return is nonlinear in this space. And of course, we have Harry Markowitz to thank. All the way back in 1952, he was writing his PhD dissertation on this very topic. He was 25 years old. When I was 25, I was lucky to get out of bed. And here's Harry Markowitz winning Nobel Prizes. And so this is really awesome. And he taught us about risk and return. But then what happens if we add a treasury security? So look on the vertical intercept. There's the risk-free asset, right? It has to have no standard deviation and a positive return. Well, what happens is that it turns the relationship into a line. And that line is known as the capital market line. So you draw a line from the risk-free asset over on the vertical axis through the tangency point on the Harry Markowitz efficient frontier, and that's known as the capital market line. And of course, the capital market line now becomes the new efficient frontier. And this is where the founder of Vanguard mutual fund families was so prescient. Is that a good word? He knew that the S&P 500 was kind of like a market portfolio. And he knew that it was a tangent portfolio, and he knew that everybody would want to buy the the Vanguard 500 index fund because it's efficient. And that's why the Vanguard 500 index fund was so popular, even though he was pretty criticized for it back in the old days. Now, what we can do is that we can use individual stocks for our portfolio to come up with something called the capital allocation line. So the capital market line is for the entire market. The capital allocation line is for individual portfolios. And notice that second right angle point here. According to the two-fund separation theorem, all investors, regardless of risk, will hold a combination of the risk-free asset and an optimal portfolio of risky assets. And I'm here to tell you right now, we'll do this at length when we get to level 2, that optimal portfolio of risky assets is known as the tangent portfolio, and it's also the market portfolio. All right, let's finish up here as quickly as we can. And remember when I said to you, imagine yourself with a wheelbarrow full of money on the floor of the New York Stock Exchange and how you gravitate? Well, this graph here on the bottom right, this pretty much gives us a sense of where you're going to take your wheelbarrow. All right, so note that if you're risk neutral, the green parallel line, you may just flood your money throughout the floor of the New York Stock Exchange without any cares about risk, right? You just want an expected return of, let's say, 10%, and you don't care what the risk is, right? So that's constant over the entire range of standard deviations. But sometimes you may go above that. Sometimes you may go below that. And so look at the bottom. If you're a risk lover, boy, notice what you're doing. You're going to take extra risk, even and as long as you get some kind of a positive return. That's why there's kind of a downward curve there. And then depending on your level of risk aversion, you might have a flatter slope, low risk, moderate risk. Those are the two blue curves there. Or you might have high risk aversion. And so very conservative investors have high aversion to risk. So what they require is they require lots and lots of extra compensation, extra expected return for just taking teeny amounts of risk. Teeny amounts of risk, that's not a finance term. So what we can do is we can grasp from whether we're red or blue or green or whatever that color is at the bottom, pink, wherever we are in this standard deviation and expected return space, what we can do is we can convert those utilities, we can convert it into an indifference curve. And so this is really where you get conservative investors who have steeply sloped indifference curves, or aggressive investors who have flat investors curves. And so all we do is we match up look at the green line, there's our capital market line. All we do is match up the slope of the indifference curve with the slope of the capital market line. Notice that top right angle point. For risk-averse investors, the indifference curves run northeast. This is what I was telling you about the football players trying to push this way and then push upwards. And so we're always trying to get that. But sometimes the right side of the offensive line is not as strong as the left side of the offensive line. And so they kind of tilt back this way. And that's why you hear announcers say all the time, boy, they're going to run over their right tackle over there. That guy, he can block anybody. And that takes us through, just a really long, but I think a really fun reading. So we covered all this stuff here. What's the most important thing? All those return measures, compute the risk and return of a portfolio. Those are probably clearly the two most important of these. But then don't forget about efficient frontiers and optimal allocation. All right, what I want you to do is I want you to go to the reading, and I think there are 43 problems at the end of the reading. Get your calculator out, and you ought to be able to work through those pretty quickly. So, hey, thanks for watching. Have a great day, and good luck studying.